Okay, this has been very hectic for me, and I have lost track of where we left off last time.
Didn't we just finish chapter 7 and start at 8?
We started at 8. Yeah, we finished 8. Okay, so we're ready to start chapter 9. So let me get the screen share on. And this is called Advanced Topics for State and Local Government. And they have a list of the learning objectives here, which includes special purpose entities, special assessment taxes, leases, and pensions. So in some business accounting classes, you'll encounter special purpose entities called SPEs. These are not the same as the SPEs for government. Part of the Enron fraud involved hiding debt in SPEs. Enron violated the accounting standards that were in effect at that time. So for a corporation, a special purpose entity is a legally separate business that absorbs risk for a corporation. A special purpose entity can also be designed for the reverse situation where the assets it holds are secure even if the related corporation enters bankruptcy, which can be important when assets are being securitized. This entity holds separate assets and has investors who are separate from the initiating corporation. As long as certain accounting criteria are met, the founding corporation does not have to record the special purpose entity in its accounting records. And they would have to include it if they are the current owners. But what they've done is they've sort of created it, but then sold it off to another party. This arrangement allows a corporation to shift unrelated activities and risk away from its financial statements. Special purpose entities have many legitimate purposes, but can be abused to make a company look less risky and more profitable than is really the case. So let's move to the government SPEs. General purpose governments include states, counties, cities, towns, and villages. But a special purpose entity for a government might be a fire protection district, a park district, a public college district, and public authorities. I'm thinking the big one that's in this area is the one that controls the Pearl River Reservoir. There's a huge housing development in Rankin County that is owned by the Reservoir Authority. If the entity is engaged in governmental and business type activities, then they use GASB 34 reporting model and report the governmental part on a fund basis. And then in the government-wide financial statements, I don't think that's that important. If it's engaged in multiple governmental activities, just omit enterprise fund statements, which are not applicable. What I'm going to be asking you about related to this on the next quiz is just the definition of business and government SPEs, and this slide here on what kinds of things are included as them. I don't think these slides are that important. So I'm going to skip to special assessments. Special assessments are similar to property tax assessments, but are limited to taxpayers receiving direct benefits. Citizens in a limited area may vote or petition the government to provide a service or capital project, and the government may then assess taxes for those benefits. So they have two examples here. One is a service type special assessment. And in this example, downtown merchants want enhanced police protection and are willing to pay for it through extra assessments. Something that was similar to that in my hometown, the Downtown Merchants Association voted to assess the people there a very small amount of money for each business, which they then used to purchase the winter holiday decorations that went up on the streets, the winter holiday that they used to call Christmas. So it was essentially they're buying up Christmas decorations, and the city was taking care of them and having city workers put them up on the streetlights and stuff like that. Construction type special assessment. Example, residents want their street paved and are willing to have the cost charged to them over a period of time. My aunt purchased a house back in, might have been the 1970s in Eustis, Florida, on a one street housing development. And so somebody had bought land, built a street, built houses on the street. And when all the houses were sold, the land developer abandoned the street and said, I don't own it anymore. And so the residents wanted to have the city or county government own the street so that they'd take care of it. The city and the county said, we don't want it. We have enough to take care of already. So nobody would maintain it or pave it. They could have done this kind of special assessment and had the residents pay for the cost so that it would be added to their property tax bill. The government will use whatever fund they normally use for that service to record the special assessment tax revenue. So last time I taught this course, they had to use a separate fund for special revenue. But now if the assessment is for extra policing and then the police costs are already accounted for in the general fund, then the monies that the government gets from the assessments would be treated as general fund revenues. If the assessment were for service normally accounted for in a special revenue or enterprise fund, then use those funds. Special assessments for debt-financed capital assets. The accounting treatment depends on the extent to which the government is liable for the debt. So we have, in the case that the government is primarily or secondarily liable to pay off the special assessment construction loan in the event that taxpayer revenues are insufficient, or the other type is that the government is not liable, either legally or by choice, even if the taxpayer payments are insufficient. So the first type, the government can end up holding the bill, having to pay the bill, holding the bag, as they say. Second type, they don't. So those are going to require different accounting. Whoops, how'd that happen? So if the government's liable for the debt, then they're going to have to record the debt, record the construction costs in a capital project fund, which is usual, and then the repayment of debt would require a debt service fund. The assets constructed in the special assessment debt are included in the government-wide statement. And the effect is to treat the debt and the related project as if it were undertaken by the government, because if the government has the responsibility to pay the debt, it would mislead lenders and taxpayers if that debt is not included, even if the primary responsibility belongs to the assessed parties. On the other hand, if the contract, the special assessment is such that the government has no responsibility whatsoever for paying back the debt, then they don't have to include it in the statement of net position. And then the collections of taxes and the remittance to the debt holder would be handled in a custodial fund. So likewise, if the government has no responsibility, no obligation to pay the debt, it would confuse and mislead lenders and taxpayers if that debt is included. The new FASB standard that's going into effect for leasing divides leasing into three categories. Financing leases are leases that are essentially installment plan purchases. The leased property is recorded as a right-to-use asset on the balance sheet for the present value of the future lease payments at the time the lease is signed. The right-to-use asset is amortized over its life. The present value of the future lease payments is shown as a liability on the balance sheet. The income statement reports interest expense and amortization expense. Second is an operating lease. These are leases that don't qualify as a financing lease. The accounting is pretty much the same though. The main difference is that the lease liability is classified on the balance sheet as a non-debt liability, and the amortization and interest expense can be combined on the income statement and called lease expense. Third type, short-term leases that are less than a year and can be accounted for as either of these two methods, a right-to-use asset and a liability on the balance sheet, or the asset and the liability are not recognized on the balance sheet. It's only going to be there for less than a year. However, if the lease has a purchase option that's likely to be exercised, balance sheet recognition is required. So why finance leasing? In the past, organizations have had their installment purchase contracts written up in the form of leases so they could hide the debt from the balance sheet. In other words, they were buying something on a long-term installment plan. When they finish the payments, they own it. And in normal accounting, the way that should be accounted for is by debiting the asset you purchased and then crediting a liability account for the future payments. Some companies changed the contract and said, we aren't buying it on installment, we're renting it. At that time, you didn't have to record a liability for rental agreements. So they were doing this in order to hide the debt that they owed, and that's unethical off-balance sheet financing. So FASB and the International Accounting Standards Board had to write accounting standards that would block companies from hiding their debt. GASB does the same thing. So lease accounting for state and local governments. They classify a short-term lease as any lease contract with 12 months or less. Another kind is a contract that transfers ownership. And a third category, any lease contract that does not necessarily transfer ownership and has a lease term longer than 12 months. This is described differently from FASB, but it's very similar to FASB's standard. Short-term leases are sometimes called operating leases and do not result in the recording of liabilities in either proprietary or governmental funds. The periodic payments, which are usually monthly, are simply charged to rent expense or expenditure in the month due. Capital leases exceeding 12 months result in the reporting of an intangible or capital asset and a liability on statements reporting under the accrual basis of accounting. GASB requires that the lease obligation be recorded at the present value of the payments. This is pretty much the same as FASB's finance leases. FASB used to call them capital leases, but the new standard changed the name. GASB is still calling them capital leases. The accounting is very similar. Lease payments are composed of or comprised of two amounts: interest on the outstanding obligation and the payment of principal. In addition to the lease obligation, an intangible asset is recognized for the present value of payments, plus any down payment made at the inception of the lease. The intangible asset is amortized to expense over whichever is shorter, the lease term or the underlying asset's estimated useful life. In a governmental fund, at the beginning of a capital lease, they would debit capital expenditure for the present value of the payments, credit cash for the down payment, and then credit other financing source lease proceeds for the liability. Don't know how I missed Christie. Questions or comments on that before we move on? Okay. The general fund using modified accrual doesn't show the lease asset and lease liability in the general fund's balance sheet. But when they transfer it to the government-wide statement of net position, they have to make an adjusting entry to include that asset and liability in the same way that the enterprise fund recognizes it. So they use a worksheet entry and they convert what's called the capital expenditure to a lease asset, and then the lease proceeds are renamed lease liability. On accrual-based statements like an enterprise fund, the present value of lease payments is reported as an asset and liability. In government-wide and proprietary fund statements, over time, the leased asset's value in the government-wide statement of net position is decreased by its accumulated depreciation, and the liability is decreased by the amount of the principal retired with each lease payment. So in an enterprise fund, they sign a capital lease, they debit leased asset for the present value of the payments, credit cash for the amount they're using in the down payment, and then credit obligation under capital lease. Now, this is really the same way that FASB did it before their new standard. Names are different. In FASB, the asset would be called a right to use asset. GASB is calling it a leased asset. Debt service fund and lease payments. If you have an obligation for future lease payments, you could use a separate debt service fund, or it could be incorporated as part of the general fund. If it's in a governmental fund, both the payment of principal and payment of interest result in an expenditure, but keep the amount separate, because when The government-wide statement of net position is prepared. Principal and interest would not be treated the same. Okay, so that's lease accounting. And pensions have two categories of reporting. Plan reporting is what's reported in the pension plan. And employer reporting is what the employer who's paying the pension to employees has to report. So plan reporting, businesses usually would not be doing this because there's usually a third-party finance company that administers the pensions. What they're talking about in this gray box here is if the government has its own pension plan that it administers itself, this is what that plan has to report. So it has a statement of fiduciary net position that reports the excess of currently available resources over benefits currently payable to retired employees. So it's not looking at the long-term liability, just the current liability. The statement does not report a liability for amounts expected to be paid to current employees when they retire in the future. On the other hand, for the employer, the central issue is measurement and presentation of the net pension liability, displaying financial position and the related recognition of pension expenditure or expense. So you might say, change this a little bit. The question that the plan reporting is trying to answer is, can they pay this year's pension payments? Is there enough money in the fund? Well, the issue for employer reporting is whether the employer is investing enough. So for employer reporting, the total pension liability is the actuarial present value of projected pension benefits that are attributable to years of service already required or already performed. And that is what a business would call the PBO, projected benefit obligation. The fiduciary net position of the pension trust fund is the excess of these accumulated resources over benefits currently payable to retired employees. So this is different from businesses because the business looks at the total liability. Or in other words, fiduciary net position is they subtract the benefits currently payable and then get a net pension liability. A business calls these accumulated resources plan assets. We have the employer has the total pension liability that they owe, the total plan assets, and the fiduciary net position. The total pension liability is the actuary's estimate of the present value of the future benefits earned so far by employees. So they owe it to them. Plan assets is the market value of the investments owned by the employees to fund their retirement. A fiduciary net position means the employer has invested more than is currently needed to finance the pensions. The difference between the net liability and plan assets would be reported as an asset. It could be described as a prepaid pension asset. On the other hand, most organizations have not fully funded the plan, and the estimated liability is greater than the plan assets. So then they'd have a net pension liability, which represents the organization's need to put its money where its mouth is and do a better job of keeping its promise to its employees by investing more money into the plan. So proprietary funds and the government-wide statements have to show their net pension liability. Pension expenditures, and governmental funds are essentially on the accrual basis. For proprietary funds, they're on the accrual basis. Okay, so it says 3 items affect both the liability and the expense. First is current period service cost. And the current period service cost, that means how much pension the employees earned this period. It's discounted to its present value. Then as time moves towards having to pay the pension, the present value of the liability increases. So the second cost is interest. And this is offset by earnings on plan investments, because if the investments earn money, then it costs less for the employer to fund the plan. Now, this section here, additional expense, that really should say, I'm gonna have to change the wording here. In intermediate accounting, they called this for business actuarial gains or losses. And when the actuary is doing the calculations, all sorts of things can change what they think they owe. Contract could change, demographics could change, the economy could change, including interest rates and expected earnings on planned investments and so on. So all those things can change how much they owe. And if they owe more, they'll have to record more expense. If they owe less, they'd record less expense. The discount rate, that's the interest rate used in the present value calculations. And they would use the expected rate of return on pension plan investments or the average interest rate on municipal bonds. Okay, that was a lot of material. Any questions about that? Okay, other post-employment benefits are retiree benefits other than pensions. They could be health care, disability, long-term care, and life insurance. Like pension, there's two levels of reporting. Reporting for the plan, which is a fiduciary activity, and employer reporting. Unlike pensions, however, many governments operate on a pay-as-you-go basis, meaning that no assets are set aside for other post-employment benefits, and there's no trust to report among the fiduciary funds. No trust means that there is no trust fund with investments in it, no plan assets, so the whole liability is owed and is not offset by any plan assets. This is not fiscally responsible management. And it means that they're promising complete health care benefits to employees for an indefinite amount of time, and they're not recording it. Accounting for OPEB obligations is very similar to pensions. And that finishes off this section. We're close to running out of time here. So in the next couple days, I'll be getting the next quiz posted up. I don't know how many of you took the initial quiz. I haven't checked for a few days. Sorry, an insect just tried to fly into my glasses. How many of you have never ever taken a quiz on the internet? So most of you have or aren't listening or don't remember. Okay, so I'll get this posted up onto YouTube as soon as I can. Remember,
The next quiz, chapter 7.
Yeah, chapter 7. So I'm saving this file because I added stuff to it, and then I'll delete the old one and replace it with this one. Insect again. Well, if there's no other questions, then take care. Listen to what they're telling you about the epidemic. And I'll see you on Wednesday. Bye now.